Well, good evening. Thank you very much for coming along this evening to listen to myself, Brett Griffiths, and Kathleen Conroy from Gadens talk about superannuation and specifically demystifying what self-managed super funds are all about. So tonight we'll be talking about a few different topics. Essentially, we'll go through where are we at with the current state of play as far as the proposed changes around the around superannuation that the coalition government has essentially put forward, remembering that they are still proposals. We'll also then be talking about what superannuation is, self-managed super funds, talking about limited recourse borrowing arrangements and then how that can sort of interrelate back to the proposed budget changes. And then going through a case study and then talking about the advantages and disadvantages around having a self-managed fund. Because essentially some of you tonight have self-managed funds, some are still looking at the prospects of it. So hopefully we're sort of covering a broad range of everything that will provide you a little bit of education for this evening. So this should take about an hour. By all means, if you have any questions, I'm happy to sort of take them along the way. I will put a caveat around that though, that if there are becoming lots of questions, we might actually hold them over to the end, just in respect for people who actually have to sort of take off at 6:30 or thereabouts. So just putting that caveat out there. So moving along, so where are we at as far as the proposed changes? So a little bit of a rewind on to where all this started. So the 3rd of May this year, the federal government handed down the budget. Inside the budget, they made the 3rd biggest change that we've had within the superannuation history. So super's been around since about '93 in its current form, and what they proposed earlier this year was the 3rd biggest change that's been around, and that includes the introduction of the whole system itself. So by no means should we discount the importance of what they're looking at doing. As anyone who's been playing the superannuation bingo game, there's been lots of flip-flopping, lots of changes about what they've been talking about. So even inside their own internal party room politics. The changes that they initially proposed were quite dramatic, particularly for a coalition government that typically favours less legislation and more big business and more wealth creation, essentially. What they've really done is try and, I believe, cut Labor off at the knees as far as the whole superannuation environment to take it off the table running into the election. I actually think they went too far with it and they did themselves some damage. So what they really have proposed is a number of measures. The first one being that going forward, well, from 1 July 2017, your pension account cannot have any more than $1.6 million in it. If it does, to be tax-free. Now that's an important distinction. So you can have 1.6 million per member tax-free. Anything that you have in super above that will be taxable. So what do I mean by that? Inside super, the earnings, including income and capital gains of a pension account is tax-free. The accumulation account is taxable. So 1.6 million of equivalent of the earnings of the asset base of 1.6 million tax-free. Anything above that will be taxable. So how that's determined is essentially two ways. Either an actuary gets involved, which isn't a very expensive process, or you can what's called segregate assets. So you can say my pension account will have these assets and my accumulation account will have these assets. So you can split them up that way to manipulate, if you like, the system. So that's the first big change, that they're now actually limiting how much you can have in pension phase. What does that mean as far as balances going up, down, all that sort of thing? We don't really know. We haven't seen any legislation around this. At the moment, it's all just, this is what we're proposing. The next thing is the non-concessional contributions. Now, at the budget, they announced a $500,000 lifetime cap. That's now gone. Now what they're saying is that you're able to put contributions into super up until the point where you have $1.6 million inside super. When you hit that point, then you're not allowed to put any additional non-concessional contributions. So by non-concessional, I mean after tax money. So you can still put in concessional where you're claiming a tax deduction, but where you're not claiming a tax deduction, you might have a spare $100,000 lying around. If you have more than 1.6 million, you can't put that into super anymore. If you have less than 1.6 million, then you can, but only in increments of up to $100,000 per annum. Some of you may know about this thing called a bring forward, where you can combine 3 years' worth into one go. They're still allowing you to do that, but obviously instead of currently being 540,000, that will now be only 300,000. So they're really restricting the frequency and how much you can put into super. One really good measure is the removal of this thing called the 10% test. So right now, to be able to put money into super and claim a tax deduction, you have to be essentially prove that you're not gainfully employed by an employer to put money into super and claim it as a tax deduction personally. So as an employee, because my employer is putting money into my super for me, I can't actually then say, well, I want to put more in and claim a tax deduction for it. You've got to be self-employed to do that. From 1 July 2017, they're getting rid of that test, which is great. Administratively, it makes things a lot easier. You can put in up to, well, it will be 25,000 by then, regardless of the source, it doesn't matter. So if you're an employee, you can put more in and claim a tax deduction. So that's a really good thing. And as I just quickly mentioned, the reduction of the concessional caps to 25,000 and the non-concessional to 100,000. With inside superannuation, there are two types of pensions you can have. One that's called an account-based pension. So that's where basically you've what's called met a condition of release. So you've either retired or turned 65. Or the other type of pension is called a transition to retirement income stream, or TRIS, as the acronym I've got there is. What that means is that you have met your preservation age. So under the law, you've got to be of a certain age to access your super. So you've met your preservation age, and you can start to draw an income stream. The initial intention behind that was that you'd start winding back your work and starting to access your super. So it's sort of like dipping your toes in the water as far as a pension goes. Typically though, that doesn't happen. People will start their transition to retirement pension, receive their money out and still be working full time. So what they're sort of trying to do is to make that less attractive by the assets of the super fund now being taxable if you're on a transition to retirement income stream. An account-based pension, the assets will be the income on those assets will be tax-free. So there will now be a real importance, if you like, to identify the difference between have you actually retired or met that condition of release, or are you just doing it because you're of a particular age? So that's going to be of a real more important focus over the next 12 months, and then obviously going forward, because that measure also is a 1 July 2017 start. The reducing of what's called the Div 293 tax, the threshold for that. So at the moment, if you earn more than $300,000 if you earn more than $300,000 and you put money into super, instead of the super fund paying 15% tax on those contributions you put in, you'll now pay up to 30%. So instead of that threshold being $300,000, they're dropping that down to $250,000. So basically they're lowering the bar at which it becomes less attractive, if you like, to put money into super. So if you're earning $250,000, it means that you're paying top marginal tax rate, so 47 cents on the dollar. So there is still an advantage in putting it in, it's just not as much. So it's a 15% rather than, or 17% including Medicare, as opposed to the 37%. So that's, or 32%. So that's where the difference for that comes in. And a really good measure that they've also announced is the ability to bring forward or collate your unused concessional contributions. So the premise behind this is those who have been out of the workforce for a period of time to then start going back to work, you're earning money, you want to contribute to super, you can actually put more than that $25,000 in. You can actually essentially aggregate it or combine it and put in up to 5 years worth. So up to $125,000 in one go and claim a tax deduction. So it's not just a case of 25,000 and that's it. You may be able to use up to 125. Now the important thing with that measure is that we assume, because once again we haven't seen any detail about it, but it will be a retrospective measure. So in other words, you've got to wait 5 years before you can claim $125,000. And if you've been, say, putting in $10,000 over those 5 years, or the 4 years prior, you've already used up $40,000 of that $125,000. So just some things to keep in mind. But what that brings into play is some planning around, say, a property, or you're selling assets down. So if you're selling an asset, you've only put in, say, $40,000 over the past 5 years, then you can claim a tax deduction to help reduce your tax bill a bit more. The trick with that measure is that you have to have less than $500,000 inside super to access it. So it's really designed more around those that don't have a lot in super. So think about, it might be if you have, say, a joint property, and typically what you have is a husband who has more money in super than the spouse, so you might put the spouse or claim more of a deduction for the spouse for that sale of the property if it's in joint names. So that's where you can, potentially utilise that strategy a little bit. The important thing with all this is at the moment it's only what the coalition have proposed. It's still got to go through the lower house. Presumably, I think that Labor will essentially support it and go through. The upper house, being the Senate, then have to put it through. If Labor are supporting it, once again, it should go through. But there's obviously some machinations with the crossbenchers and the Greens that may hold some of this up. But I think by and large, what we've got now, most will support. The reason why I say Labor will is that they basically have copied the forward estimates, so the savings measures around what we've been talking about just now, when they did their budget forecasting before the election. So they're sort of trying to mirror the coalition on some of this stuff. So now that the coalition have got themselves sorted, I'm expecting the rest will essentially go through. So I'm not expecting much deviation from what we've just been talking about, for better or worse, unfortunately. So what that really means is that basically at the moment we have a two-stage process for under 50s and over 50s for putting money into super and claiming a tax deduction. That will change to $25,000. Instead of being $180,000, we're now going to have $100,000. Still having the 3-year bring forward, but remembering we've got that $1.6 million cap essentially, or ceiling. So that's going to become really tricky if you have multiple super funds, because only the ATO will know. Because all super funds have to tell the ATO what your member balances are. That happens now. So if you have more than one fund, it's going to be administratively, it'll be more difficult for you to work out, can I put money in, can I not? It will also mean that as far as knowing what your balance is at the beginning of the financial year, can I actually put money into super this financial year? If you have a self-managed fund, you may have to wait until your accountant's actually done the work. So that's going to potentially create some dramas, if you like. Fortunately, we've now moved to a system called Class Super, which is more online, all about data feeds, all that sort of thing. So we can pretty much, assuming that you've got bank accounts, shares, fairly, I'll call it plain vanilla stuff, even property, we can pretty much tell you what your balance is on most given days. Whereas previously, that was a lot harder for us to do. So moving to that sort of system in hindsight is a great thing, because it means that we can actually help our clients a lot more. So I suppose before we move on to some other stuff, is there any questions around that, the proposed budget or the proposed changes with Inside Super? Have I confused everyone so much that I don't really care? Looks like it. All right, beautiful. All right.
Can you just repeat what you said about transition to retirement as opposed to account-based?
Yeah, sure. So essentially, the two types of pensions, account-based is when you have what's called meta condition of release. So typically, there is 3 stages through that process. If you're over 55 and retired permanently, if you're over 60 and ceased a gainful employment arrangement, or over 65. So meet any of those 3 things, then you can have an account-based pension. So what that will mean is that under these proposed changes, the income that is attributable to that pension account will be tax-free. Capital gains attributable to that pension account will be tax-free. That's how it works right now. A transition to retirement is where you've reached 55 and you want to start draw money from your super. You don't have to satisfy anything else. So you can still be working and do all those sorts of things. There's no relationship between retirement and accessing your super. Under that, under the proposed measure that we're talking about, it's no different than if you're in accumulation. You're still paying tax at 15% on your income and 10% on your capital gains, assuming you've held that asset for more than 12 months. So there's really no difference now if you're in a transitioned retirement pension or if you're in accumulation from a tax point of view. The difference obviously is that transition to retirement, you're drawing money out, you're drawing a pension out. So you're accessing your super. You have money that you can, surplus cash that you can use to potentially put back into the super fund and claim a tax deduction on. So there are ways in which you'll be able to use that as a strategy, and it's what happens now. The big difference though is that now you're claiming, the super fund is getting a tax benefit for you being inside a transition to retirement pension. Going forward, under these measures, you won't get that tax benefit inside the super fund. So before you could sort of have your cake and eat it too, now they're just letting you have your cake. So you just have to go hungry.
Or eat someone else's cake.
Or eat someone else's cake, that's right. Alrighty, well, we'll move on then.
Okay, so having a look, just going generally into superannuation, and then we'll tunnel down into the self-managed funds. So basically superannuation is what it has been since it was introduced. So it's forced savings for your retirement or for the benefit of a dependent if you pass away before retirement. So we say it's forced because 9.5% of your ordinary time earnings is paid into your super automatically. That will stay at 9.5% until June 2021, and then then go up by 0.5% until it hits 12%. So for present purposes, we're still looking at that 9.5 and certainly still forced. Now, some of the things that I start to get excited about accounts, like the law behind it. So whether you've got a self-managed fund or not, but bearing in mind that that's what we're going to be focusing on, it's governed by the legislation, the principal piece of legislation being that Act, commonly called the SIS Act, and the regulations made under it, the actual deed for the fund, and also trust law. So just looking at that a little bit more generally, you might have, say, a self-managed fund, and you might have a brilliant deed that says you can do certain things, but if the law says you can't, doesn't matter what your deed says, you can't do it. So the legislation will override. So the legislation will say certain things like you can't access your super unless you hit a certain point or a condition of release, or you can't lend money from your fund to a relative, or lend to a member or a relative, or give financial assistance using the resources of the fund to a member or a relative. A whole lot of things. So basically, that's the law, and there's nothing you can do about that. The trust deed is really important. So superannuation is a trust. And this isn't just a fancy legal thing. It's important because there's a whole body of trust law that sits beside super law. So the trust law says that a trustee is bound to act within its powers that have been agreed, and that agreement is the deed. So you draw the deed, and if you're wanting to do particular things within that context of the broader law, you make sure you put those powers in the deed. Because if the trustee does something that's not even in the deed, even though the law, the superannuation law, might say you can do it, if it's not in the deed, you're acting beyond power, and that's a breach of trust. And a whole lot of things can flow from that. One of the worst being that if you breach the trust and everyone ends up in court, you might find that you can't then be indemnified from the fund. And if you lose the case, you might find that you're paying everyone else's costs personally. So it's important, a couple of things flow from that. So it's important to have a deed. It's important to keep that deed up to date, because when the law changes and you don't change your trust deed, you might find that you're lagging behind. If you want to do something like buy property or whatever, you go to your deed and see what you actually have the power to do. And another thing that flows from that is make sure you can actually find a deed. So it's very often the case, particularly with funds that have been around for quite a while. Well, I think this is a copy of it, and I think I varied it, but I can't find that. It's not just being pedantic, you actually do have a problem, because you can't prove then what you're allowed to do. And you can't say, okay, well, let's just change it, because you need to follow the rules to change it. And if you've lost it, you don't know what the rules are. So if you're going to do something like buy property or whatever, not that it might be relevant for much longer, but have a transition to retirement pension, you look to your fund deed to make sure you can actually do it. So make sure the power's in there, make sure you can find it, make sure it's up to date, and if you need to vary it, make sure you use the rules for the fund to vary it, or if you need to change the trustee or anything like that. So then there's that broader trust law, and going back to what I was saying a moment ago about not acting outside your powers, there's that part of trust law, but there's also more general obligations on any trustee. So if you're holding something on trust for someone, regardless if it's super or whatever, you're bound by certain trust, you're bound by trust law. So for example, trust law will say you can't walk into a situation of conflict. So you can't be conflicted in your decision making, and if you are, you're supposed to go to the court to get that resolved. You can't act in face of a conflict. So there was a case, Worcester and Morris, Victorian Supreme Court, back in 2013. Mrs. Morris, they had a self-managed super fund. Husband passed away. They were both the members of the fund. He had a binding death benefit nomination in place, leaving his part of the fund to his daughters, not to his, well, it was his second wife. So Mrs. Morris, on husband passing away, became the trustee. For a while she had a son in there, but not relevant for the purposes of this. So she was then the sole trustee, and then she incorporated a company of which she was the sole director, and that controlled the fund. She decided that this binding nomination wasn't in fact binding, and she did get a legal opinion after a few things had happened, but went down the route of, okay, no, it's not binding. And she then defended that action in court when the daughters said, no, it is binding. She said, it's not binding. Not only is it not binding, because it's not binding, I get to decide who gets the money, and I think it'd be a great idea if I got it. Great decision. I can understand that. So she acted in a situation of conflict. She obviously favoured herself. She defended the position in court. Everyone spent a lot of money. And she lost. She lost because she was wrong, it was binding, and the court said, well, you acted in conflict. Because you acted in conflict, and it was a really bad decision, particularly to choose yourself, you are, not only have you lost, you're paying for everyone's fees for court, and because you acted in breach of your general trust obligation, you can't be indemnified out of the fund. So you are paying it personally. So bad decision. So the court decision wasn't bad, it was bad outcome for her. So not only does she have to pay her own court costs, and being a lawyer I can tell you that that will always be a lot of money, she had to pay the other sides as well. So these things, while they might be frustrating, they are really, it's a strong line of law that you have to be cognizant of when you're running a fund. So you're not only caught by super, you're caught by general trust principles as well. And then the other thing just from that is to remember that even though it might be your money, as the ATO used to say, it's not yours yet. So you can't use your super to support your current business activities, which can be very tempting, particularly with easy access to funds these days. You can have online accounts and all the rest of it. It's not yours. And certainly when we see structures, when we're advising the bank, and people have come up with these brilliant ones, okay, we'll just take the debt into the fund, and that means that we can release it from our home or our business or whatever. If you're taking on using your fund for that purpose, the law will say that's just tantamount to accessing it. So you have to be really careful with how you deal with those monies and what the way you use your fund. And the thing to remember is that it is for your retirement. It's not to be used for any present day purpose, whether directly or indirectly. Slide, please.
Oh, that one. There we go.
So just focusing now down onto the self-managed fund. So a self-managed fund is super, and it's just the same. It's a special form of super. The thing with a self-managed fund, which we have up on the slide, what the ATO will tell you, is other than certain exceptional cases, the members will be the trustees. They'll either be the trustees of the fund or the directors of the corporate trustee. And what that means is that it's you, the person who is a member, who is actually controlling it, who is making all the decisions. It's not some abstract third party. And because it's you, that means no matter what that decision is, you, the member / trustee, are responsible for it. You're responsible for ensuring that you comply with the law. You're responsible for your investment decisions. And if it all goes wrong, the ATO will be knocking on your door and not some other person. Over to you, Brett.
Thank you. Now, all that legal stuff, I need some more numbers. So essentially, what does the self-managed super fund environment essentially look like? So as at 30 June 2016, this is what the ATO are telling us that super funds look like. So there is 577,000 self-managed super funds around, with just over 1.08 million members. So that's a lot of people that have self-managed super funds. Remembering our population's about 25 million or thereabouts. Year on year, self-managed super funds increased by about 27,000. So that's the net impact. So between what leaves and what comes, that's what we're basically left with. So there's a continual growth in having self-managed super funds. Typically, a self-managed fund, 2 members, they're aged between 45 and 64, and there's about just under $500,000 inside the fund. That's the typical environment. Now, in total, these 577,000 super funds account for $603 billion of our $2 trillion superannuation environment. That's a lot of zeros, just saying. So basically 30% of the superannuation wealth is managed by 1 million people. Breaking that down a little bit more, basically direct property accounts for about 19% of that, or $115 billion. And about 19% of that is actually using limited recourse borrowing arrangements. So how does that look? You will have to marvel at this graph. So basically, these are everything. This is the asset allocation, as it's called. So basically where all the assets are sitting. 30% sit in shares, 26% sit in cash, and then the next biggest asset class is property, of which most of it is actually commercial or non-residential property. And only 4% of the superannuation environment relates to loans. So there's a lot of talk about the loans and how they're causing all these problems and everything else, but the reality is it is still a fairly small percentage. Now, that I'm sure will grow, without question. Now, the thing to bear in mind too is that some of this 15% here, they may have had borrowings at some point. We've been able to borrow since 2007. We've had a lot of clients that have borrowed money, they've paid back their loan, and now they don't have that loan anymore. So this figure here has increased over time. However, because people have been coming out of the loan portion of the pie and into the other portions property of the pie, it sort of moves around. So there probably is more growth than really what that indicates. But at the end of the day, we're not talking about, as far as the entire superannuation universe goes, we're not talking about a lot of money. Bearing in mind too that only self-managed super funds can borrow to buy assets. So it's very unique to the self-managed environment. Over to you.
Indeed. So for anyone who doesn't have a self-managed super fund and is thinking of establishing one or advising someone else in relation to it, there's a set of steps that you have to follow. First thing you do is you consider whether you're going to have individuals or a company as the trustee, and in the next slide we'll talk about that a bit more. And you think of a name for the fund. Have a short name because you will write it a lot. And we see some great names, but man, people are going to be so tired of writing these names. So they're really fundamental things. You've got to have a trustee. You can't have a trust unless you have a trustee. So you've got to have that looking after it structure, and then you think of a name for your fund. If you are going to have a company as the trustee of your fund, you get that company incorporated. And while there is an expense involved in that, so for example, it varies depending who you go to, but say $400 plus GST to set up the company, and then you get the ASIC's charge to register it, $400, currently $469. Over the course of a fund, it isn't a lot of money, and as we'll talk about in a moment, there are advantages to having a company over individuals, and you'll generally find if you ask the professional advisors, oh, what should I have, they will generally advise you to have a company. Thank you for nodding. Then, so you get your trustee, which we've been talking about. Couple of things, you can get those off the shelf. You do have to read it, and you do have to make sure that it's actually properly drawn. Some people like to do as much for the client as possible, and they'll actually give you one that's already got a date on it. Well, that's really a problem because if you haven't signed it yet and you put it in the drawer for a bit, and then you go and incorporate your company, and then a year later you go to do something with the fund, and the lawyer looks at it and says, actually your company signed this a year before it was incorporated, how did that happen? So, little things like that you do have to be careful. And if you're going, the trustee will sign the fund, which is accepting the position as trustee, so the incoming trustee agrees to hold this fund on these terms. So little things like if you sign it, you don't sign as trustee because you're not the trustee yet, you just sign it and then you become the trustee. So little things like that you do have to be careful of. And you now also, if you're the individual who is the trustee or a director of the corporate trustee, the ATO requires you to sign a declaration. You have to sign that within 21 days of taking up that role. And that sees you recognising certain rules. And basically, if it all goes terribly wrong, the ATO will pull on your declaration and say, no, you did know about it because you signed this declaration 6 years ago that said you did. So you have to sign that declaration within 21 days, and then you keep it for 10 years, at least 10 years, maybe longer. The safest thing with anything to do with your fund is to have a special fund file, and any bit of paper you sign goes in there, because you are bound to keep certain things depending on what it is between 5 to 10 years, but if you've got it, you've got it. You appoint an accountant for the fund, so somebody to obviously do your returns and look after it, and you get ABNs, tax file numbers. You don't automatically fall into the tax benefits of the self-managed super fund or the super fund regime, you actually have to elect to be regulated by the legislation. And the law says you've got to elect to be regulated within 60 days of the fund being established. And now, if it's a bit longer than that, it doesn't necessarily mean you can't, but you may find that the ATO will say to you, you're not going to be complying until you do. And the ATO will say, well, hold on, more than 60 days, why haven't you signed it? Please explain. Not a good start. And once you are regulated, it's regulated for life. So you can't decide, well, actually, I don't really want it to be a self-managed super fund after all, or, gee, there's a couple of things I did wrong with that. Great plan, we'll change it from a fund to a family trust or something like that. No, it doesn't work. Once you're regulated, and if you want out, you have to wind it up. Then a few other technical things that I have up there. That's the one that I'll draw your attention to before we move on to the next slide, is the investment strategy. There's various things in the legislation that are operating standards, and one of those is to have an investment strategy for your fund. And while you can change that, it has to recognise certain things, or you have to turn your mind to certain things. So, for example, the diversity of your assets, risk profile, whether you're going to have ready cash to meet reasonably likely upcoming events, and insurance for the members. And it's not just important from an investment point of view, but because it's an operating standard, they've introduced what's known as administrative penalties. And there's an administrative penalty if you don't comply with an operating standard. So if the auditor goes to check your fund and can't find your investment strategy, if that's then reported, you might find that you are faced with an administrative penalty. The administrative penalty for not complying with an operating standard is 20 penalty units. One penalty unit, $180. 20 times 180 is 3,600.
Sounds good.
Good. So, it is, things like that are important. So that administrative regime came in on the 1st of July 2014, and we'll talk about that a little bit more as well. Next. Oh, thank you.
Sorry.
So,
can I ask a question before you go?
Please.
Is it necessary to have insurance?
You don't have to have it, but you have to turn your mind to it.
Okay.
You have to consider it.
Okay.
So the trustee, do you have an individual or do you have a company? It can be either, subject to the fact if you have a sole member fund, so many people have a fund where they're the only member, you can't be the sole individual trustee. So if you have you can have up to 4 members, all the members are trustees, or directors of a corporate trustee. If you have only one member, that member can be a sole director, sole secretary of the company, but can't be an individual trustee by themselves. So they'd have to have either a relative or another person who is not their employer. They can also, as an individual, they can, as I say, be a sole director of the company, or they can have another person who's the director who is either a relative or not an employer. Why would you have a company and not individuals? If an individual, something happens to them, they step aside, they pass away, and all the name of all your assets are in the name of the individuals as trustee, you then have to change it. Whereas if you have a company and a director, something happens to the director, you don't then have to change it across the board. So it's a lot easier that way. I've certainly found dealing, if it's a sensitive situation, and I know when I was dealing with my own parents' affairs, they tend not to want to let go of something. And so if you've got an individual as a trustee, that person, if they have to step down, they've got to step down entirely. Whereas if it's in a company and they're a director, you can sort of have psychologically, you can say, okay, well, I'll step up as the alternate director, and you can still be a director, but we'll just do it so that for this period of time you don't act. So it's a nicer way of dealing with it, and I certainly found, and it was my own parents, it's just easier to deal with because they don't feel like they're giving up something. So there's that, and also the administrative penalty regime that I was speaking about a moment ago, and which we'll talk about in more detail shortly. If you do find that there's an administrative penalty, so for example that's 20 for the operating standard, if you have individual trustees, each of them will get that penalty. So if you have all four, they're all going to be paying $3,600. Whereas if you have a company, the directors as a group are jointly and severally liable. So at the end of the day, only between you have to come up with that amount. So you obviously don't want to be trying to get penalties and test the system, but if you do get it, it's a whole lot easier if, or it's less expensive if you've got a company as the trustee. So there's some of the things to think about. Your fund has got to be an Australian fund. There's various steps, well there's three parts to that. The big one that I'll mention because it probably comes up most frequently is if you're going overseas. So the central management and control of the fund has to stay in Australia. And so that means generally that high-level decisions about the fund, so high-level, okay, let's buy property or whatever, has to be made in Australia. So if you're planning to go, if the members are all planning, or the trustee, well, same, planning to go overseas, you do need to turn your mind to that. If it's a short period of time, probably won't be a problem. You definitely have to start thinking about it seriously if it's going to be more than 2 years, but it's not a strict 2-year rule. If you permanently leave and it's less than 2 years, you may still fall foul of it. And if you're there overseas, say for 2 years and 6 months, provided that it wasn't permanent, so your, you know, the employment reason you left or whatever might have extended, but your house is still here, you haven't sold it, you haven't established permanent residences or whatever overseas, then you may still be okay. But you certainly don't want to go, gee, that'll be fine, it's less than 2 years, or conversely, it's not necessarily a problem if it's more, but you do need to look at it really closely. Certain people can't be a trustee, so if you are not mentally capable, if you're under 18, and if you're a disqualified person. For the first two of those, you can get around it. Mental incapacity, someone, your legal personal representative, so if you've got an enduring power of attorney in place that allows it, then that attorney can step in and the person without the capacity steps out. The trustee has to allow you to have that enduring power of attorney. Age, parent or guardian can step in until the minor attains the age of 18, or can be the director of the corporate trustee. One thing though, if you are disqualified, so if for example bankrupt or the ATO has disqualified you because you have really annoyed them, you can't get around it. Once you're disqualified, you can't use a power of attorney or have something else to you step down while you get out of your bankruptcy or whatever. No, not going to work. So the enduring power of attorney only works for those first two. The other thing about a trustee, they can't be paid for their trustee duties. If you're a professional, for example, someone like Brett, who is an accountant and is properly qualified?
Apparently.
Okay. And provides services to the public, and they're doing what they would normally do, then they can charge for doing that in respect of their own fund. But you couldn't charge for trustee services, and you can't think, oh no, I might try this accounting thing, or I'm going to do property development and I'll be a property development advisor, if that's not what you are qualified for and not what a service that you would provide to the public. So if you are running your fund and everything's going along swimmingly, what you have to bear in mind, as I said, there's a whole lot of rules and regulations, and you'll frequently find that if you've contravened one of them, you've probably contravened more than one. So, for example, we will talk about the Mr. Jekyll and Heidelene. They've got the J&H Super Fund, and Heidelene's an accountant, and so she's decided to take she's running an accounting business, and so she's got this whole self-managed super fund happening, and hubby, Mr. Jekyll, says, yeah, leave it to you, honey, whatever you reckon's a good thing. she gets into a little bit of trouble with her business and thinks, oh, that's a bit of a worry. If I just take a little bit out of the fund, it'll only be for a couple of months to tide me over. And then I'll put it back and it'll all be in the same financial year, won't be a problem. So she does that. Bit of a concern. And then not only was that not such a good decision to start out with, but it didn't quite get better with the speed that she would like. So it was a bit easier the first time, so she took a little bit more and ended up taking about $128,000 out of the fund. Finally, hubby finds out about it, and so does the auditor, and everyone's a little bit upset, and she says, no, well, it's okay, I shouldn't have done it, but really all I did was just borrow from the fund and I'm going to put it back, so okay, we'll have to tell the ATO, but it'll all be fine. No, that's probably not what's going to happen. So what the ATO would say, well, yes, you did lend it to yourself, and that's a problem, so we'll get you on that. You were supposed to keep that fund purely for the sole purpose of your benefit in retirement, or the member's benefit in retirement, or as we said at the outset, if something happens before retirement for your dependents. So you've contravened the sole purpose test by using it to prop up your business. And did you document these loans at all? What was the repayment regime? Where's the loan agreement? So you've contravened that one as well. You didn't keep it at arm's length. So we'll get you on that one also. And $128,000, if that's more than 5% of the market value of the fund, you've also contravened the in-house asset rules. So what you'll find is this little thing will just balloon into your worst nightmare. And I have seen it happen, and once the ATO decide to audit you, your life is misery. So every transaction, all your bank accounts, it'll all come out, and you might think you're strong at the start, but you're a blubbering mess by the end of it, because it just all comes out. Mr. Slideman, thank you. So this leads into the whole enforcement regime if it does go wrong. So what we were talking about with Jekyll and Hyde, that in the legislation there's two sets of things. So there's civil penalties. So all of those, the sole purpose test, in-house assets, not keeping it at arm's length. Basically, if you, there's civil penalty provisions. So if the ATO, if they're serious, and they're all serious, but particularly if it's a lot of money, the ATO can seek an order in the court against you. And if it's successful in that order, it can be up to 2,000 penalty units. So 2,000 times 180, $360,000 for each offence. So in the Jekyll and Hyde example, that 360 times 3 or 4, a lot of money. So you have civil penalty provisions. And it's, as I say, the ATO as the regulator, if they decide to take an order, they can go back anything over the last 6 years, take it to court, and that might be the outcome. That is exemplified in that case we've put up there. The Felix Superannuation Fund started, I think it was 2005, didn't start out well. Mr. Rodriguez, as one of the trustees, basically put a fake loan in place, and it just went downhill from there. Continually basically taking money out of the fund and doing weird and wonderful things with it. For example, he bought a whole lot of gold and silver bars with the fund as an investment, but then sold the bars and pocketed the proceeds of sale. So, taking it round. And all of that came out, and the ATO took it to court to get those orders against him. The court, when it gets to court, they're bound. There's a set of sort of procedures that you'd follow. Okay, these things are really bad, but we also look at these things. So you're a good character, and he had character references other than in relation to the fund. He was a good character. There was a psychological report. He was a troubled person at the time, was under a lot of financial stress. So all of those things weigh up against all of the things that you did wrong. And in that case, the judge said, okay, these are all the things you're wrong. We've all agreed that it's serious, but you've cooperated with the ATO, and it was agreed that he had, which is always a good plan, by the way, if you do get in trouble. So the judge said, look, go off, you and ATO, go off and work out a penalty amount and, you know, see if you can agree on something. So they did. They agreed that for the lot, and it ended up, it was over $100,000, but over time he paid it all back, and the ATO had disqualified him as ever being a trustee of a super fund again, so there was that element of punishment already. And they agreed that he would pay $40,000 and the ATO's fees for the court, so that was another 14. So it cost him 54, which probably wasn't a bad outcome for him in the circumstances. So there's those civil penalty provisions, but then there's a whole lot of administrative directions and penalties. So you can get rectification. This is as of 1 July 2014, because as you can imagine, to go through that court process and to do all the rest of it is time consuming, and it costs the ATO a lot of money. So if the ATO believes that, reasonably believes that there has been something gone wrong, they can give you a written direction to rectify it, and it's a written direction to do a certain act within a specified time and then show them that it's done. So there's those directions. There's education directions. So again, if they reasonably believe that you've done something wrong and perhaps you're just not used to running a self-managed fund, or you've recognised it and you're contrite and all the rest of it, you'll get a written direction to go off and do an education course and in a set period of time and show them that it has been done and re-sign that trustee declaration. Or there's the administrative penalties, like those operating standards. They range from 5 penalty units, so 5 times 180, up to 60 penalty units, depending on what provision you might have contravened. You have to pay it. You cannot pay it from the fund's resources. You must pay it personally. And as we said, if it's individuals, each of you will get it. If it's a company that's a trustee, the directors as a group get it. You may be able to avoid it if, for example, Jekyll and Hyde are lien. If Jekyll didn't know anything about it and it was just fraud, he may be able to argue, look, I didn't know even though you're supposed to, it was fraud, she gave me all these things to sign, I read them, but then she transposed my signature onto something else, something along those lines. If it's the first time and you find yourself with an administrative penalty, provided that it's not extremely serious, you may ask for a remission, and the ATO can remit it in whole or in part, but don't expect that to happen more than once, and don't expect it to happen if it's been a serious contravention. Then the ATO can also do other things, so they can disqualify you as a trustee of a fund, they can make you give an enforceable undertaking to fix various things up, they can direct you to wind up the fund, they can make it non-complying. So they're all powers that they have, and I've seen them all in action. And one you don't want to get nowadays is the disqualified as a trustee, because it is actually published on the World Wide Web. So it used to be in the journal, paper journal, but now that is actually published. So even if you then get undisqualified, forevermore your name will be up there, and particularly if you're an advisor or you're running a business and people Google you, which they do all the time now, up will come disqualified. So it's not a good look. And even if, as I say, it's then you become undisqualified, the ATO are not bound to remove that from the net, so it's there forevermore. So it's sort of one of those flow-on effects of modern technology. Mr. Griffiths.
Thank you. So I'll just quickly touch on a bit of a case study, and this is an example that we had with a client here. So basically, John, we'll call him, he was age 60, and he owned a property that he was running his business out of. It was over in West End actually. He had no debt on the property, and he basically came to us and said, right, what can you do to help me sort of with my superannuation, because he didn't really have any other savings. So he had some money in super that he built up over time, and this was a few years ago, so the property price really hadn't moved too much, so there was really no capital gains on it. So what we're able to do is basically move the property into a self-managed super fund using a combination of capital gains tax rollover relief that's available to anyone, in certain circumstances, moved the property into the super fund, so via a borrowing arrangement. So he borrowed some money from the bank to basically pay himself, made some contributions into the fund, used some capital gains tax rollover relief to move a $3 million property inside the self-managed super fund. So he already had $1 million, so 33%, was able to, or 30%, was able then to move the other $2 million worth into the super fund through a combination of contributions, borrowings from the bank, and through the CGT rollover provisions. Because he was age 60, we were then able to start a pension for him. It was a transition to retirement pension, which then meant that the rent that his business paid to the super fund, now as the landlord, was tax-free to that super fund. So he was able to basically improve his retirement savings by, instead of paying someone else, for argument's sake, for leasing, he was able to pay it into the super fund. So he's able to essentially not only move the asset in there, but then generate income that he's supporting through his own business. So that was one technique that we've used through limited recourse borrowing arrangements to help clients increase their superannuation balance.
So if you're looking at a limited recourse borrowing arrangement, you've probably heard the basic structure. So essentially it's your fund that is borrowing to acquire an asset that it's permitted to acquire. So the fund gets a loan, buys off the vendor, say that the legal title to that property is held on trust while ever the loan is in place. So the thing about limited recourse arrangements is that while you have the loan, the legal title to, say, the property can't be held by the fund. It's got to be held by a second entity, and that's where you people say the custodian or the bare trustee or the property trustee. So the general rules, you can borrow money to acquire a single acquirable asset. So the important thing about that is, what does single acquirable asset mean? So if you have two parcels of land next to each other and you can sell them legally, you can sell them separately, then it's not a single acquirable asset. If you have two parcels of land crossed by a house or some other structure that is of significant value with respect to the land, then it is a single acquirable asset. But if you get two blocks of land and think, oh, I really want to buy them together, I'll just put up a little demountable that I'll knock down the next day, that probably won't cut it. So when we talk about a structure going across, it's actually something of significant value that is affixed to the land. The asset, as I say, is held on trust for the life of the loan, which means that you have that property trustee or custodian who will hold it on trust while ever that loan is in place. Then the law says that the fund has the right to get it back, or to get that legal title, by making one or more payments. What that basically means is it can have that legal title once it's paid off the loan. So you can pay off a loan over the course of, in bulk or whatever, but you're not getting it. The fund is not getting legal title until the loan is paid out. And then when you have that property in the fund, and it's when you've acquired it, unlike other things, you can't charge other assets of the fund to support that loan. It's very contained. So when you get the loan, and the mortgage documents are specially drawn so that it's only that asset in that fund which is vulnerable. No other assets in the fund can be charged with any obligation in relation to that loan. So, a couple of things to think about. When you get property in your super fund, you can use the borrowed money to repair or maintain the property, but you cannot use the borrowed money to improve the property. And all those words have their general dictionary meaning. So repair, to fix something, partial, that sort of meaning. To maintain, so to prevent something from happening, or not to prevent, but to maintain against a particular event. So if the roof's about to fall out, you think, oh gosh, we really need to put in a new one of these special roofs because we're in a particularly windy area, something like that would be maintaining. But you can't use the borrowed money to improve the property. Even if, you know, there's more in the loan, you can't do it. So what does improve mean? If you change the general character of the thing. So if you buy vacant land, you can't then put a house on it during the course of the loan because that would be an improvement. Or if the land or the land and improvements that you acquired were residential, you can't change it to commercial because that would be an improvement. And there's, on either side, it's very clear. So some things you might say, well, that's clearly an improvement, or something else like fixing a window clearly isn't. But there is a grey line in the middle, and if the closer you get to the middle, if you're going to do something significant, your safest course of action is to get a specific advice from the ATO and say, okay, this is what I propose to do, you know, is that permitted, basically? And you give them all the facts because you won't be able to rely on the advice unless you tell them all the facts. What you can do though is improve it, you can improve with money that's not borrowed, but you can't change the character of it. So you can't use, just in case I have confused anyone, you can't use borrowed money for any form of improvement. You can use money already in the fund that's not borrowed to improve, but you can't change the character of it. So you could never use it, as I say, to go from residential to commercial or whatever. But if you want to add on some extra rooms without the borrowed money, you can do that. And as I say, there's that grey line in the middle, so the more substantial the work you do, the good counsel will always say get an advice from the ATO first. A couple of other ones, an option agreement. So if you have an option to buy a property and you pay an option fee and you borrow for that, you'd have to get another recourse borrowing arrangement. It would have to be a separate one to then actually acquire the property. Or if you have an option agreement, just be careful because you might say, so Brett's got an option to buy a property and he says, oh, well, I'll nominate Kathleen to buy it, and the option fee that I paid can then become the deposit under the house. Well, you couldn't do that because if I was buying that house, my super fund needs to pay for the entirety of that purchase. So it would be Brett's deposit and I couldn't use that. So things like that, you'd need to be careful because that wouldn't work. As I said at the outset, make sure you've got all your deeds in place because you want to see that you've actually got the power to buy that property, to borrow, to charge the assets of the fund, to have a mortgage, and to also have this other custodian or trustee hold the property. You're allowed to do it by law, but you want to see all those powers in the trustee because if you don't see it in the trustee, you're going to have to vary the trustee before you do it. And if you don't do it voluntarily, the bank will look at it and say, well, we're not going to lend you until you do those things. You also want to make sure you have all the deeds in the chain of deeds for your fund, because if you've varied the rules or you've changed the trustee and that wasn't done in accordance with the rules at the time, then everything after that is vulnerable. So if you change the trustee, say you changed the trustee 5 years ago from individuals to a company, but you didn't do it in accordance with the rules for the fund, you may find that that company has not been properly appointed as trustee, and if it ends up before the court will say, no, that company was never properly appointed, it was always the individuals. So you really need to be careful about making sure you can produce all the deeds, which is why the banks will get very finicky about it. Produce all the deeds and they will read them to make sure that each step has been done properly, because the minute one step isn't done properly, everything after that is vulnerable to attack. And related parties, certain assets you can only, if you're buying from a related party, you can only buy business real property or another form of asset, and Brett will talk about that.
So just in relation to related party borrowings, so you don't have to borrow from a bank, you can actually borrow from yourself. Now, this is quite an interesting one because there's actually, under the superannuation law, there's actually no reason for you to charge interest and things like that. So if you're borrowing money from yourself, you don't have to charge interest under the super law. However, under tax law, the tax office have recently formed a position to say, well, actually you do. So their big stick is what's called non-arm's length income. So they've said that if you borrow money from a related party and it's not according to what we consider to be a commercial loan, then we will make that the income from that particular asset, we'll tax that at top marginal tax rate. So that's their big stick. Now, what they consider to be a normal commercial loan is a loan that has a written agreement for property. It has an interest rate at the moment, it's 5.75, but that is each year they restrike that interest rate as of May each year. You can only have fixed interest for 5 years for property, up to 15 years total loan. Your loan to value ratio, no more than 70%. The security has to be registered and repayments, principal and interest on a monthly basis. Now, you don't have to comply with this requirement. So I actually have some clients that have loan arrangements to themselves or to a related company that they don't meet these requirements. Yeah, that's okay. It just means that they either may pay more tax, or secondly, because the rent coming in is less than the loan that's being repaid, they're actually, because of basically they've borrowed essentially too much for the property, it means that they're in a loss situation. So there's no tax to pay anyway, so they might as well try and meet these requirements if you don't have to. So you don't have to meet the requirements, but best principle is that, yeah, this is the starting point, and from there you can sort of work out, okay, what do we need to do or what don't we need to do to achieve your objective. So it's really a case of being eyes wide open to what the outcomes are and what the results of those outcomes end up being.
So if after all that you still want to have a self-managed super fund, and I'm the lawyer so I get to say the disadvantages, so it really isn't cost effective. There is no rule that says you have to have a particular amount or value to have a self-managed super fund. But you do have to, you have your accountant, you might have the lawyer involved, you get it audited. So if you've got a small balance, it simply mightn't be a cost-effective option for you. You need to understand the trustee responsibilities, and it's easy, particularly in a presentation, to do all the scary bits, but there are a lot of enforcement actions that can be taken against you, and it is your responsibility, and you need to understand those responsibilities. And if you don't comply, it is checked every year, and it can go off the rails really quickly. You need to understand that there are restrictions on investment, and we didn't go into those a lot this evening just out of time, but it's certainly something that you have to be aware of. You've got to have the time to actually do the work. So anything that you do as a trustee of the fund needs to be recorded. So even if it's only yourself and your partner, you need to have a proper meeting and you need to have minutes. You need to make sure there's a paper trail for all your decisions, because, well, firstly, the law says you have to keep those records, and you also want it as evidence, and we've many times called on it to show that you did actually turn your mind to certain things. If you make a bad investment decision and you lose the money, or more so, there's no statutory protection scheme. If, for example, you invest in something and through no fault of your own, but through the fraud of whatever the fund, for example, might have been, the whole thing goes belly up. If it's a public fund or not a self-managed fund, there is a statutory protection that you may get your money back, but not if you have a self-managed super fund. And the reason for that is with people pay, like there's Bahamian into APRA that's effectively pays for that protection scheme, but self-managed super funds don't pay into it. So as I say, if you're through no fault of your own, whatever you invested in goes belly up and it was through fraud, you're not going to be protected. As we've said, you are responsible for the performance of the fund. You're responsible for the investment decision, so if it's not something that you're interested in looking at, you might think, well, seemed like a good idea, it certainly will give you control, but it mightn't be for you. And the biggie, which I think is coming up more and more, it is that loss of capacity. You do have to be conscious of the fact you might get to, and perhaps loss of capacity is a bit harsh, but get to a point where you simply don't want to do it anymore. And it's always easy to leave it till it's too late to step aside, and it can become a real problem.
And I suppose the advantages of why people may have a self-managed fund. Essentially, most of the reason is it's all about control. So you either want to control the investments or you want to control essentially the estate planning outcomes. Because having a self-managed fund means that you have greater flexibility in achieving outcomes that you want. Potential cost savings. I know there are some clients that have had an APRA fund that were charged 8% per annum on their balance. When they move that into the self-managed fund, they end up saving a few $1,000s each year, just because of the way that particular or super fund they had was structured. It was rather expensive. And as I sort of mentioned, you've got greater strategic opportunities. So not only around the whole estate planning thing, but potentially tax planning. And it means that you're able to deploy different types of strategies, particularly as I sort of started at the beginning of tonight, talking about segregating assets and cherry picking what assets are going to be in pension phase or what aren't. You can do all that inside a self-managed super fund. Inside a non-self-managed fund, it's a lot more difficult. And obviously property is a big focus as to why a lot of people set up self-managed super funds, because they're able to sort of own that asset as they want, whether it be their business or even a residential property inside the fund, which you can't do via an APRA fund. So that's typically why people will set up self-managed funds.